What is an interest rate? This is a question that many first-time homebuyers ask themselves as they enter the real estate market for the first time. Moreover, it's also a question that people that are using credit cards ask themselves, as it also applies there as well. Anywhere where you're borrowing money, you're going to be paying interest. Defined simply, the interest rate is the amount that a lender charges the borrower, and it is usually identified as the percentage of the principal amount of money owed, which is the amount of money that was loaned out in the first place. Interest rates are most common with two specific types of lending, one of which is the lending of a mortgage. People buy mortgages because they simply can't afford to spend $500,000 on a house up front in cash. So they got to get the money somewhere, so they go to a bank or financial institution and say, hey, you give me that $500,000, and what I'll do is I'll pay you your interest, a couple percentage points every single year for 30 years. You'll make your money and I'll get my house. Everyone wins. The other side is credit cards. People use credit cards to purchase things, and sometimes they use them, to kind of accrue points and get extra benefits, but other times people just don't have the cash in their bank account. So they turn to a credit card and say, okay, listen, I'll spend the $100 here on the credit card, and then when I get paid, I'll pay off the credit card. And if you don't pay off the credit card, you get charged with interest for that purchase, which is usually significantly higher than the couple percentage points of a mortgage. Interest rates on something like a credit card is usually in the range of 19 to 21%, whereas the average mortgage, as of recording, sits around 3 to 5%, depending on your credit history. It's also worth differentiating between the two different types of interests. In the case of a mortgage, you are paying something called simple interest, which means that you're only paying interest on the principal amount, or the amount of money that you initially borrowed. In the case of something like a credit card, they utilize something known as compound interest, which means that you're not only paying interest on top of the initial cost of the product, but if you don't pay off that amount, you actually pay interest on top of your interest on future payments. That is why it can be very dangerous to only pay the minimum amounts on credit cards, because you end up in a situation where you're going to be paying interest on top of interest on top of interest, because the set amount on your credit card continues to increase month over month if you continue to spend money and only pay the minimum amount. It's also very important to consider the correlation between your credit history and the amount of interest you're often charged. Let's take, for example, the purchase of a used vehicle. Let's say you're buying a car for $20,000. You go to the car dealership, you get it, and they say, okay, well, we're going to finance you, and they check your credit history, and you got a spotless credit history. It's A-okay, everything's great. They say, okay, well, you can now get this car, we'll finance it for 2.9%, and that is a simple interest rate. So you buy the $20,000 car, and you're going to be paying it off for the next 5 years at an interest rate of 2.9%. Not bad. But let's say you're someone with a spotty credit history. You've missed some payments, you had a rough time with credit. They do that same credit check and they see this. And they say, okay, well, you can still get the car, it's not a problem, but now it's going to be $20,000, but your interest rate is going to be 4.5%. Okay, so what you have now encountered is that you're going to be paying more money because the lender is seeing you as a little bit more of a risk to lend to. So they want to make more money up front to make sure they cover their bases. That's a very simplistic explanation of it, but that's kind of how it works. That's why a lot of companies, especially in used auto loans and in auto loans in general, they'll do credit checks before issuing the money. They want to know that you are going to be good for the money because they don't want to be out that money. They don't want you to default. They don't want you to go bankrupt. So they check your credit history, and that is one of the ways you can find a differentiation between the amount of money one person pays in interest and the amount of money someone else pays in interest, depending on their credit histories, even though they're buying the same item, which might in this case be a used vehicle. Let's take a look at a real example of how interest rates can impact something like a mortgage. Now, this is a mortgage calculator provided by Canada. The dollar amount, or the currency value, doesn't really matter in this example. It could be American dollars, it doesn't matter. I just think this site is really well laid out and is great for educational purposes. So let's say we're going for $500,000 as the principal borrowed amount. Depending on where you live, that could be all you need, or it could be really, really nothing. Because if you're in New York or in Vancouver, 500 grand ain't buying you much. But in some places in the world, hey, it's everything you need. Interest rate, 3%. We'll go with an easy 3% right now just for the purposes of seeing how this impacts us here. Amortization, this is how long it takes for you to pay off the principal amount. So you're going to try and pay off the $500,000 over 25 years. You're going to be paying once a month or 12 times a year, and you're locked into this interest rate for 5 years. Okay, that is the term of this agreement. So you're going to be paying 3% interest for 5 years. let's take a look at how this actually impacts the cost, the interest rate specifically, this 3%, okay? So when you take a look down here, okay, we're at 3%. Now, I know there's a lot on the screen here. Let me actually just explain what's going on here. So over the term, those 5 years, you're going to be making 60 payments once a month. You're going to be basically paying $72,000 off of the $500,000 that you owe. However, you're actually going to be making $69,000 of interest payments, okay, for a total cost of about $42,000. Over the entire mortgage, you're actually going to be paying $210,000 in interest. $210,000 on the principal amount of $500,000. So you bought a house for $500,000. The house actually cost you, with interest, $709,000 over that amortization period. Okay, let's remember these numbers. Okay, so total cost over 5 years. So you're paying basically $69,000 in interest payments over the term, $210,000 over the amortization period. So 69 and 210. Come on, Alex. Changing this by just 1%, it can't be that much, can it? There's no way it absolutely makes a difference. Well, of course it does, friends. That's why this video exists. Let's take a look again. Total cost here. So we went from 69 to 93,000 over 5 years. Are you kidding me? 1% difference. Look at this cost now over the entire amortization period, $289,000. This is why people are concerned that they lock in these mortgages and then interest rates skyrocket over 5-year terms. And after those 5-year terms, what happens if the interest rate's even higher? So the $500,000 mortgage over the amortization period costs you almost $800,000. Okay, what happens if this continues to go up because of inflation? What if it doubles from 3% to 6%? Okay. And now I'm not trying to make light of this because I know that this is a very scary reality. This can happen. Interest payments, $141,000 over the term. $459,000 over the entire amortization period for almost $1 million total cost of borrowing. Guys, this is why interest rates are so important. And there's one thing I haven't really talked about yet. Look at the payments. $3,200. That's a mortgage payment per month. At 3%, right? At 3% from $3,200, you're at $2,300. So $800 a month. Oh, let's call it $1,000 a month, right? Who knows what happens? Let's say $1,000 a month. I don't know about you, but having to pay an extra $1,000 a month because interest rates went up, that would be hard for me. That's hard for anybody. So this is why people are most certainly interested in what's happening with interest rates, because their impact on the affordability of housing is extreme. Their impact on all borrowing of money is extreme. So when we talk about an interest rate increase of 0.5% here, 0.5% there, 1% here, 1% there, suddenly you start to see, whoa. You're looking at massive increases. And suddenly if your term comes up, and you have to sign up for, you signed up originally your term for 3, and the next term is going to be 6, then you're looking at significant differences in how much money you're expected to pay, how much money you're going to be putting in for interest. And that is why the interest rate is one of the most important things to consider when purchasing a home. Thanks for watching, and if you'd like to learn more, I really think you should check out this playlist because it is essentially a video dictionary of all terms that I think you'll find useful in the world of finance. Thank you so much for watching, and we'll see you in the next video.